Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 2. And Chapter 2 is all about the role, historical perspective, and direction of management accounting. Now, for our learning objective, at the end of this lesson, the student should be able to first explain the historical perspective of management accounting. Second, define management accounting and identify its objectives, scope, and limitations. Third, explain the role of management accounting and its direction toward a specialized field. Fourth, assess the significance of management accounting information system, or the MAIS. Fifth, differentiate internal from external users and financial accounting from management accounting. Sixth, identify the various licenses and certifications that a management accountant can have to boost his professional career. And lastly, apply the ethical standards in the practice of management accounting. Now, Chapter 1 established the urgent need of strengthening financial information as well as educating a new breed of smart managers to combat competition. Now, if in Chapter 1, the financial information caters both external users, in this chapter, accounting will address the needs of the internal users. So this is what is referred to as management accounting. This is no longer governed by any accounting standards, but management standards, and so could differ from one company to another. So what is meant then by management accounting? Now, management accounting is the process of analyzing, interpreting, and analyzing financial statements using the statements prepared under financial accounting. Now, management accounting assists managers in the process of decision making, such as pricing of the products. Second is discounting to various selected customers. Third, spending money based on budgets and beyond budgets. And lastly, we have product distribution. Now, let me discuss first pricing. It is stated here that the process of decision making includes the pricing of the product. And why is that so? Remember that pricing is a major decision that a manager should make, right? It must be a price that is not only acceptable to the owner for the fair return of his investment, but also acceptable to the consumers who will patronize the company's product. Now, we need to understand as well that there are companies that do not have a problem on pricing because their product is in competition, which means to say that the company has to price their product with minimal plus or minus based on the price of the identical products in order to compete. And on the decision-making side itself about pricing, on the issue of competition, since prices are dictated by competition, the manager should decide to focus on cost without sacrificing the quality of the product. And another thing, the process of decision making would also include discounting to various selected customer. Now, normally, managers decide to give discounts to those customers who have been in the business for quite some times or who have been very loyal to the company. Third, we have spending money based on budgets and beyond budgets. What do we mean by this? This is one of the most difficult decisions that a manager has to ever make. Imagine a boat sailing in an ocean or an airplane flying in the sky without a compass. Without their guides, they would definitely be a mess. And similarly, in managing a business, planning is an important component. The company should have a vision of what must happen to the business in the future. Now, according to Proverbs 29:18a, where there is no vision, people perish. This is also true with business enterprise. A business with no vision has a high risk of business failure, and more often, it is based on hit and miss management. And therefore, it is of paramount importance for having a vision. It is the company standards by which all performances are gauged and evaluated. And lastly, we have product distribution. And second, management accounting assists managers in the creation of policy and day-to-day operations of an organization so that there will be a consistent accounting application in all transactions of the business. And lastly, the strengthening of internal control that will give an assurance of protection not only to the resources of the company, but even in generating revenues. On the other hand, I will be discussing to you now the objective of management accounting. Now, at this point, I will be highlighting four objectives. And the first that I want to highlight to you, that would be performance measurement. Now, performance measurement is considered to be as one of the objectives of management accounting because we may be asking ourselves, whose performance do managers measure and why do they measure their performance? Now, performance measurement is the assessment of the performance of officials and employees in discharging their respective duties and responsibilities to see to it that they contribute to the total business operating efficiency. And second objective, that would be risk measurement. In here, we're going to ask the question, what risk is to be measured? Now, the risk to be measured is the risk that business enterprise allowed in order to be efficient in undertaking its day-to-day operations. And the third objective of management accounting, that would be the right allocation of business resources. Remember that businesses are generally operating within limited resources. And because these resources are scarce, these must be properly allocated to maximize the earning potential and maintain, or if not, improve financial health of the business. And lastly, timely presentation of financial statements to the management of the business. So these are the four objectives of management accounting. There are also limitations of management accounting. And first limitation, that would be, since managerial accounting is leaning on financial accounting as its foundation, weaknesses of managerial decisions are historical data. Now, the reason historical data is its weakness, it's because of the fact that unlike financial accounting, managerial accounting is forward-looking, not backward-looking, which means to say that it doesn't use historical data. Instead, it's a planning tool for the future. Okay? Second limitation, the tools are for decision makers only. Remember, the primary goal of management accounting is to provide information for internal decision making only. It provides information to managers and other internal decision makers. And the third limitation of management accounting, that would be the tools and techniques used in making business decisions serve as supplementary in support of a decision only. Now, the tools or techniques that are commonly used in making business decisions are planning and controlling. In planning, this is where the communication of the company's goals is evident. And because communication is evident, it provides guidance for decision makers. And on the other hand, this is where the sources and uses of resources are being identified. And the tool used in making decision, the other tool, that would be controlling, managerial tool. This is where performance is being measured. It can be the performance of the managers, the performance of a segment, a product, a division, etc. Okay, so these are the three limitations of management accounting. Now, what are the scopes of management accounting? Now, the scope of management accounting, first, that would be financial accounting. Why is financial accounting considered to be as the scope of management accounting? Now, financial accounting is considered to be one of the scopes of management accounting because without a good foundation of financial accounting, management accounting cannot fully operate as it is dependent on it as its basic foundation. And second scope of management accounting is cost accounting. Cost accounting is considered to be as one of the scopes of management accounting because it serves as the backbone of management accounting, as it provides the analytic tools used by management accounting in discharging its role effectively. Third, we have financial management. In addition, financial management is one of the scopes of management accounting as it is concerned with the maximization of stockholders' wealth by means of proper planning and controlling of the company's assets. And number four, we have financial statement analysis. Normally, this gives color to the financial statements. By analyzing the financial statements, one can better understand the operations and discover ways of improving the operating performance of a company as well as new opportunities. And number five scope, that would be interpretation of data. Next, it's considered as one of the scopes of management accounting because this can be performed better by comparing previous year's performance with the current year's performance. Now, the question is, how can we make our interpretation more meaningful? Now, our interpretation can be more meaningful if we present our data through graphical presentation or tabular form, which are easier and simpler to comprehend, especially for non-accountant members of the organization. And number six scope, that would be management reporting. Management reporting usually refers to the timely reporting of financial information to the decision makers. This is normally in the form of percentages, diagrams, and graphs for easier understanding of the common user. Also, the reason it's considered as a scope of management accounting is because timely reports are essential, especially in reaching a decision for the best way to utilize a company's limited resources. And number seven scope, that would be quantitative techniques. When we talk about quantitative, it talks about numbers or something that can be measured, right? Now, a scope of management accounting, this is considered as a scope of management accounting because modern day managers believe that the financial and economic data available are for smart managerial decisions. Examples, that would be queuing theory. We also have transportation model, sampling techniques, regression analysis, linear programming, EOQ, or economic order quantity. So all of these are some of the many examples of quantitative techniques. And lastly, we have inflation accounting. It's considered as a scope of management accounting because of the time value of money. Again, time value of money. If Bangko Sentral ng Pilipinas produces more bills or money, then inflation comes in. If inflation comes in, then the prices of goods and or services also increase. Now, if there is an increase in the prices of raw materials or goods and services, it will be of great effect to the cost of our raw materials. If raw materials are costly, then most likely companies are forced to increase the prices of their products. Okay, so these are the 8 scopes of management accounting. So what is then the role of management accountant? Now, the primary duty of management accountant and cost accountant is to properly account and control the cost of the product or services in order for the company to compute the markup and then come up with the selling price of the product or service. Now remember, as you can notice, previous generations had a few people doing accounting because of the small number of transactions, right? Machinery enhanced production, which resulted to more transactions. And therefore, this led to an increase in attention to what was called as cost accountant, who is the forerunner of management accounting. And later on, this cost accountant becomes synonymous to management accountant. And the prime duty of management accountant is the one which I just read earlier, which is to properly account and control the cost of the products and services. So these accountants are generally or normally housed in a company's factory for the proper monitoring of costs. But today, management accountant is separated from being synonymous to cost accountant. It becomes a separate position in the finance department. Okay, so that is the role of management accountants. So what is the direction of management accountant then? Now, for many years, management accountant focuses on generation of financial reports for its timely submission to the decision makers. Okay, so with the advancement of technology, management accountants are slowly being seen as not just report generators, but participants as well of the team that make decisions, which means to say that management accountants influence the team with his expertise in the financials of the company by coming up with sound business decisions. Furthermore, in some big companies, management accountants are no longer part of the finance department, but part of the management team that influence decision makers. So next, I will be discussing to you the Management Accounting Information System. So what is meant by Management Accounting Information System, or MAIS? When we say MAIS, it is a set of highly technological systems and procedures which gather information from a wide range of sources, compiling and converting these to a readable format for decision maker. Now, the MACE provides management with comprehensive reports of all financial information to aid them to make sound decisions. Now, this system is also responsible for providing timely and accurate financial and statistical reports for internal management decision making. Now, what is the significance of management accounting information system, or MACE? Now, the main purpose of MACE is to provide the manager a logical set of data to provide the decision maker with everything he needs for making well-informed decisions and performing a deeper analysis of operational issues affecting the business. Now, with the presence of MACE, employees can work more efficiently, and employees in all levels can check the status of inventory or any information related to their department or group. Now, as a result, transactions can be done with ease and confidence. And like I said earlier, the system is very efficient and people can be more productive in their respective posts. But there are a couple of disadvantages as well, because this system, management accounting information system to be specific, is quite costly. It is financially burdensome. Another disadvantage is that it requires an extra information technology personnel, or IT personnel, to oversee and maintain the system. Third disadvantage, it requires training of employees, because the company should train them for the effective use of the system. And lastly, the last disadvantage that would be, it requires to pay for upgrades later on because of the knowledge about the system. Now, due to these factors, companies must properly weigh in the costs and benefits before getting a MACE in order to maximize the potential use and increase productivity, and then later on, the bottom line figures of the business. First of all, we need to make ourselves be acquainted on the difference between financial and managerial accounting. Now, as a basis for comparison for definition, financial accounting is defined as an accounting system which is concerned with the preparation of financial statements of an organization to provide financial information to both internal and external users. Therefore, it is intended for all users, both inside the company and outside the company. On the other hand, managerial accounting is an accounting system for managers within the organization to formulate policies and forecasting, planning, and controlling the day-to-day business operations of the organization. So primarily, the users inside the company are managers who have to make decisions. Managers, it can be managers from different departments, just like financial manager, accounting manager, or it can either be production manager, marketing manager, or any manager within the organization. Next, second basis for comparison, we are going to ask ourselves, is it compulsory? Well, for financial accounting, yes, it is compulsory. The reason is because it has to meet the requirements of Securities and Exchange Commissions, or SEC, as well as the Internal Revenue Services, or the IRS. On the other hand, it has to meet the requirements of GAAP, or what we call generally accepted accounting principles. And in contrary, managerial accounting is not compulsory because it is way more flexible compared to financial accounting. There's no requirements that you have to meet GAAP as it is only used internally. And lastly, it's not given to outside users, so you don't have to worry about the SEC and the IRS, or does it comply with GAAP. Now, for the information for financial accounting provides monetary information only. Here, the information provided in financial accounting is purely monetary information or quantitative consideration, that is numerical peso amounts such as gross profit of 100 bottles of soda. On the other hand, managerial accounting provides monetary and non-monetary information. For example, the number of workers, the quantity of raw materials used, etc. So managerial accounting looks at and examines both quantitative and qualitative considerations. Qualitative considerations are those touchy-feeling things. For example, how does the product impact customers? How does it impact employees? Next is objective. So what's the objective of financial accounting? The objective of financial accounting is to provide financial information to external users. Financial accounting was based on transactions that had already occurred, which means financial accounting is more of a backward emphasis rather than forward-looking. When I say backward emphasis, what I mean about this is that financial accounting uses historical data for comparison. For example, if a certain company plans to apply a bank loan, then the bank screens the application of the firm first before granting the loan, because they want to know the liquidity of the firm through its financial statements. Also, if the firm has an outstanding loan to another financial institution, then they are able to meet its maturing debt obligation. So that's usually the question that financial institutions should ask before someone or before a business is going to get a loan from them. On the other hand, the objective of managerial accounting is to assist the management in planning and decision making. The primary goal of management accounting is to provide information for internal decision makers only. Primarily, the internal users of the company are the managers. May it be, again, like I said earlier, may it be the finance, accounting, marketing, or production managers, or any managers inside the organization who have to plan and control and make decisions. A lot of information that managers utilize to make decisions is not something that the firm would like to provide to external users, such as how much is the gross profit of marketing advertisement. Of course, ABS-CBN would not like GMA to know about that information, and vice versa. Next is formats. For financial accounting, it's specified. There is a specified format to be strictly followed for the financial statements to be generated. And in contrary, managerial accounting is not specified or non-specified. Managerial accounting doesn't have a specific format. Remember, it does not only does management accounting examine quantitative, but also qualitative considerations, right? Qualitative considerations may vary depending on the nature of the business. Next is time frame. For financial accounting, the financial statements will be submitted at the end of the accounting period, which is usually 1 year. Now, in accounting in general, just a brief recap, remember that there are 2 types of accounting periods, right? First is the calendar, and second is the fiscal period. Now, the Internal Revenue Services, or IRS, defines calendar year as January 1st through December 31st, or the calendar year that always starts on January 1 and always ends on December 31. On the other hand, a fiscal year is any consecutive 12-month period that ends on the final day of any month except December. And for managerial accounting, the submission of the financial statements, that's going to be as per the need and the requirements of the organization. That means to say that the submission of financial statements are more timely. Being more timely, we may sacrifice accuracy and results. Okay, so moving on to users. As discussed earlier in the introduction part, the users of the financial accounting are both the internal and external users. And for managerial accounting, those internal users only, or the managers working within the organization. Now, who are these external users? So external users are the following, but not limited to. It can be potential investors, creditors, government agencies, research scholars. We also have financial institutions and competitors. On the other hand, the internal users of financial statements are company owners, accountants, may it be management accountants, finance accountant, or cost accountant. We also have managers from different departments within the organization. And lastly, we have the auditors. And for publishing and auditing, for financial accounting, it is required to be published and audited by statutory audits. And for managerial accounting, it's neither published nor audited by statutory audits. And finally, the last key area that I want to discuss to you today, that would be the ethical conduct of management accounting. Now, a management accountant has two options as to what professional paths to undertake. And these two paths are, first, if the management accountant opted to join a specific company as part of the management team, first, he should be a person of integrity. Second, he should show real confidence in every task assigned to him. And third, he should know how to handle information with strict confidentiality. Again, integrity, confidence, and confidentiality. These are the traits that a management accountant should possess if he or she wishes to join a specific company. You need to have an integrity and a sense of confidentiality because you will be handling the finances of the company, which means to say that you should not divulge any financial information to outsiders. And second, ethical conduct. If the management accountant opted to practice management consultancy, then the following standards must be observed according to Cabrera 2011. First, we have the standard of integrity and independence. The integrity and independence standard means that the practitioner must practice independence and should act with integrity and objectivity. And second, we have competence. Here, proficiency must be observed by the practitioner throughout his engagements. Next, we have due care. It means that due professional care should be exercised by the practitioner. Next, we have client benefits. When we say client benefit standard, it implies that the practitioner should inform the clients about any doubts regarding the probable benefits from the engagements. Next, we have planning, supervision, and control. Now, this standard implies that there should be an adequate planning and supervision to control the conduct of the engagement. And so, for this matter, it can have a basis for evaluation related to the scope of the work. And next, we have sufficient relevant data. It means that the relevant data obtained, documented, and evaluated should be sufficient for the accountant's conclusion and recommendation. And finally, we have communication of results. Communication of results signifies that all findings as a result of the engagement should be communicated to the client. I think that's a good place to stop. So if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.